In the midst of the inequality, South Africans are warned of massive fuel price hikes. This as oil prices continue to soar amid Russia-Ukraine conflict. Trade unions are now calling on government to find ways to help citizens who are already burdened by high fuel and food prices. What threats does this impending fuel price increase have on the economy and South Africans? The chief economist at Alexander Forbes Investment, Isaah Mhlanga, joins us now to unpack this for us and more. Here's a question for you tonight on WhatsApp, 072-110-5584. What do you think government should do to shield the poor, the working class in the country from the impending fuel cost increases? Isaah, good evening, and thank you very much for your time and joining us tonight here on In Focus.
Thanks for having me.
Now, when we look at the current fuel spikes, at least before this obvious now conflict and tension in Russia and the Ukraine, we're looking at 2 or 3 factors. One was the fact that we were coming off the pandemic, and there was this bounce back of some sort, a booming economic growth in the world. Looking at that, then you had limited oil supply because producers were being cautious in allocating capital, and so they were not like OPEC, for example, was very cautious, and they're not scaling up production fast enough. And then, of course, we have the geopolitical tensions. Explain to us, if you're looking at those 3 factors and how they play out as far as the global economy is concerned, and therefore what that means for the South African economy.
So generally, an increase in fuel prices directly from oil prices is a tax on consumption, both for households but also for businesses, because they do use a lot of petrol in transporting goods from different places. So globally, every time we have seen a fuel price shock of this magnitude, it has preceded a global recession since 1960 without a fail. So that is a big risk, but it depends on how long it's going to last. But so far, if we just look at the situation, it seems it's not going to abate anytime soon. So one, the oil price matters quite a lot. We've seen the U.S. yesterday put an embargo as far as Russian oil is concerned. They're no longer going to import it, which means it's going to have a significant shock in the oil markets, which have already saw closer to $130 per barrel. It's going to play out into South Africa as fuel price. The second factor, which is obviously the rand exchange rate compared to the US dollar, it has remained resilient so far, which has helped to cushion that increase in petrol price. Why did it do it? It remained quite resilient. Commodity prices generally that we export, the likes of platinum, palladium, gold, iron ore, and coal, they have also increased, given that Russia and Ukraine are major producers of those commodities. So those geopolitical risks that continues in those 2 countries mean there is expectation that supply into the global market is going to be limited. But for South Africa, that is a benefit because we export those commodities. So there is an offsetting mechanism if we look at industrial or metal commodities versus oil price. But as far as the inflationary impact is concerned, we are likely to see quite an increase in terms of inflation locally. Obviously, we have been seeing a gradual increase before the current shock that we are seeing in Russia and Ukraine. This now just makes things even much more worse.
Now, is the inflation, I think you've just went into load shedding there for a moment, which is probably something else that we will need to talk about that we're dealing with in this economy. But is oil a major driver when it comes to inflation, right? It's argued that, for example, oil makes up, 3% of the global GDP. So, yeah, it is important, as you put it, because it comes into all the other issues. It comes into food, it comes into transportation, and so on and so forth. But is it a major driver when it comes to inflation, or is something else at play here as well?
Look, there are many components that are driving inflation. Oil, if you look in terms of fuel, it's about 4.8% in terms of its contribution to the CPI basket. So it's not very large. We still have goods inflation that continues to increase because of the supply disruptions from COVID. that has meant that there is less supply of these goods, but also when they are there, it takes too long to transport to where they are required. You can see that if you look at the difference between goods inflation relative to sales inflation. So they have spiked quite a lot. That contributes, but also electricity prices. We have seen electricity prices that have continued to increase. The recent ruling from NERSA, just close to 10%, which was given to Eskom, that is going to add to that fuel price. And also food price inflation. We have drought conditions in South America, in Brazil in particular, which is a major supplier of grain into the global market because of the La Nina that we are having. In SA, it's causing above average rainfalls, but in South America, in Northern Hemisphere, is resulting in drought. Again, the impact of the Russia and Ukraine war is also having an impact there. You would know that these two countries are major suppliers in terms of wheat, which we use in the manufacturing of bread. So that is leading to higher grain prices. But there is also a different component that is coming out of the war in Russia and Ukraine, which is the production or the supply of inputs into the agricultural process, particularly fertilizer. It's one of the biggest producers globally, which means there's going to be an increase into the input costs of farmers, which ultimately are going to also increase domestic food production costs, and that is going to be ultimately passed on to the consumer. So it's a number of things, but I can summarize them as follows. It's oil prices that have increased. It's energy prices because Eskom continues to require more tariffs to increase. It's food price inflation that continues to rise because of drought conditions, but also goods inflation because of the supply side constraint, because of lockdowns that are still taking place in the likes of China, in Germany, and some states in the US that continues to have disruptions in goods production and transportation.
Is there anything that our government can do? I mean, obviously, oil prices are determined by the US dollar exchange, and the Russia war, Ukraine, is not really something that we have direct influence on and can certainly say with certainty how long it will go. On the other two spaces, energy, goods inflation and food price inflation, is there something that a government can do? We'll try and get to that when we come back. Isaah Mhlanga, Chief Economist at Alexander Forbes Investment. Let's hear your views also tonight. 072-110-5584. What do you want government to do as far as shielding the poor and the working class from the impact of rising fuel prices? In Focus continues next. Back tonight on In Focus, Newzroom Afrika, Channel 405. The conversation is on the impending rise in fuel costs. In April, expected that the price of petrol will rise by another 2 rand. Of course, Labour is now saying government needs to step in here and assist citizens, particularly the poor and the working class, to shield them from the impact of these rising fuel costs. So, Isaah, you had put it very nicely before the break, the drivers of this inflation, and that will make life a little bit more expensive. Is there any space for government to play in the energy prices, in the goods inflation, and in the food price inflation?
Look, we know from the recent budget that National Treasury, in collaboration with the Department of Mineral Resources and Energy, is relooking through the various taxes and levies that are put on into the fuel price. You would know that the price of petrol in South Africa is slightly higher than the price of petrol in Botswana, in Namibia, for instance. And part of the story is the levies that are imposed or that are added into the fuel price, which is another method of generating revenues for the government. Perhaps there is a space to actually reduce some of those levies, but ultimately it means somewhere within the government expenditure we have to see some reductions in spending that is going to be offset by those reductions. So ultimately, something has to give for fuel price to go lower. Beyond that, most of the inputs are really determined in the global markets, and there's nothing much that government can do, given that we are not an oil-producing country, but also we can't influence the performance of the dollar-rand exchange rate.
Yeah. Speaking of that, we're not an oil-producing country. There are some who are saying a global movement towards sustainability. In other words, an orderly energy transition, I beg your pardon, can protect against oil price spikes. How far a truth is that, and how far are we as South Africa from enjoying the benefit of that?
Look, we are too far from that. I think over the last couple of days, we saw European countries looking to coal again to use that as an energy source, given their reliance on Russian gas. So it just says to us it's going to take a little bit longer. So the just transition needs to be approached much more carefully without haste, because energy security should trump everything else, because without energy we simply don't have an economy that is functional. So we need to make sure that it's done in an orderly manner, which ensures that the economy continues to function. But yes, in terms of climate change, it's happening. It's going to take some time, but it needs to be staggered in a way that does not jeopardize the energy security of the country. And we are learning from the Europeans that even the coal that has been termed is too dirty. They still require it. The gas that has been historically, or that is currently sourced from Russia, it was too risky, and it continues to be too risky for European countries because it can be closed anytime, and which also tells us that the gas reserves that we have, we actually need to explore them, because it's a big source of energy that can circumvent our domestic energy needs.
Yeah. Now, Isaah, you've already mentioned the announcement by U.S. President Joe Biden on the barring of oil from Russia. What does that mean for producers? I mean, at this particular point, are they adjusting their production levels? What does it mean, and what will it mean for security of supply?
Russia constitutes about 10% of global supply of oil. And, if there are embargoes that are being imposed on Russia across the world, it means that 10% of oil supply will eventually be taken out of the market. Many countries, including OPEC and the US, have signaled that they're going to release their strategic reserves to offset that decline in oil supply. But it's not going to be quick. It's going to take some time. So it means over the short term, we'll continue to see oil prices that remain quite high or even continue to increase. And that is going to be quite inflationary. But it's not necessarily the level that matters. We have to look at the difference between the change in that level for us to determine what impact it will have on inflation. If, for instance, oil price were to remain at $130 per barrel, it means in the first half of the year, we will see an increase in inflation. But beyond that, because the change would have been constant, we are going to see the change that is going to collapse to zero, and that is going to be disinflationary. So the impact is really whether we continue to see an increase that is sustained, or we are going to see a flattening of the oil price over the course of the year.
Yeah. What would that mean then for the central bank that would like to see, I think, the inflation sitting at about 4.5%?
Look, I think the central bank is caught between a rock and a hard place. On the one side, inflation is increasing, and indications are that it will continue to increase for quite some time because of all these supply constraints that are playing out. On the other side, economic growth is moderating, and potentially because of the trade disruptions, we are going to see even more a slowdown in economic growth. We still have load shedding, and that is also going to play out into what the central bank has to consider. But for all intents and purposes, growth is weak not because interest rates are too high. It is weak because we have not done the structural reforms which the central bank cannot influence. It means the central bank is likely to be much more aggressive and front-loading much of the interest rate increases to create policy space so that if the global economy goes into recession or significant slowdown, and thereby also influencing the South African economy to slow down significantly, they can then cut rates enough to be able to stimulate the economy like they did when COVID hit. Because interest rates had enough space, they cut quite significantly, 300 basis points, which had an impact in terms of stimulating consumer demand. So the same needs to happen. They need to create that space, but they need to create fast enough before the global economy experiencing a significant slowdown.
Yeah. You also mentioned, of course, that threat of a recession. And when we think recession, we think 2008. And many are saying even now, South Africa, for example, is still suffering the after effects of that recession in 2008. Maybe remind us of what that actually meant. That was, at the time, I think, caused by the financial sector, the banks, that caused that recession.
True, the recession that we saw in the global financial crisis was, emanating from the financial sector, shocks in credit markets. What we saw, in COVID is quite different. Supply side shocks because of the, regulation that has been imposed by government. But we have seen a quick economic recovery out of this one because it's quite different to what we experienced during the global financial crisis. Nonetheless, the economy still remains about 1.8% below where it was in 2019 in the fourth quarter, which means also from a jobs point of view, we are unlikely to see all jobs being recovered over the next 5 years. With a 2% economic growth, we can only generate about 1.4 million jobs by 2025, which are too slow to actually recover all the jobs that have been lost.
Yeah. And the energy supply issues that we are dealing with even as we speak right now, I mean, I'm sure that would also have an impact on the recovery of South Africa at this particular point.
Indeed, as of this morning today, we saw Eskom announce stage 4 load shedding, essentially meaning that we have just close to a 55% energy availability factor, which means we are going to have significant disruption as far as business operations are concerned. And the longer it remains, the more impact it is going to have on the economy. And I'm sure you would have seen for a number of times now experiencing this intermittent load shedding as we speak, and that disrupts business activity. But also it sends a bad message to investors. You are not going to see a big company which is going to come into the country to establish a large manufacturing plant if it is not guaranteed security of energy. And that's quite important because it sends a bad signal in terms of business confidence or investor confidence. That's why we need energy security to be guaranteed, and guaranteed very fast, so that we can take into account all the funds that are available in the global economy, particularly the ones that are targeting climate change or decarbonization of economies.
Now, the mix of all this, the geopolitical conflict, the rise in fuel costs and possible rise in inflation, does that mean we can kiss the 4.9% GDP growth that we were talking about yesterday goodbye? It's really not going to touch sides when it actually comes into the bigger picture.
Look, I think the 4.9% is historical, so that's gone. It's unlikely to be repeated. Going forward, economic growth is going to moderate to roughly about 2%, and even below that, in 2023. But the current Russia-Ukraine war also has significant implications over the medium term. What you would expect is for all the countries in the West to concentrate on rebuilding Ukraine after the war, which means there's going to be less foreign direct investment flows into emerging markets, including South Africa. From about 9 wars over the last 30 to 40 years, it's quite clear that during a geopolitical shock, foreign direct investment contracts, and the year after, we also see a foreign direct investment contract, particularly in emerging markets and in South Africa, because most of the countries that will be involved in the war or that has that geopolitical shock will be concentrating on rebuilding their own countries first before they look outwards. So we should expect something similar. FDI flows to EMs and to SA are likely to slow down quite significantly this year and next year, which means we have to do a lot more work to make South Africa investable and to actually, publicize that through the investment conference, which the president started in 2018, to make sure that investors offshore, they are aware of the economic reforms and the progress thereof that we would have implemented once the impact of the war finishes.
Now, of course, the question for the consumers is, what do we do at this particular point? Do we stay put? You want them to be buying goods. You want them to be buying food. You want them to be spending on those luxuries. But with the type of forecast that we are looking at, they might want to also maybe sit on their little kitty at this particular point and hold tight.
Indeed, when prices across the board are rising, consumers reprioritize their spending from luxury goods to necessities, and that is what consumers need to do. But much more importantly is to live within your own means, because going overboard and using credit, ultimately when interest rate increases, is going to bite. So it's really just constraining yourself to live within your own means, concentrate on necessities, and reduce a lot of the luxuries.
Isaah Mhlanga, appreciate your time. Thanks for coming on. Chief Economist at Alexander Forbes there. Isaah Mhlanga giving us, of course, that detail that we need to understand how this is going to impact on your day-to-day living as a consumer.